ever wondered, how are Bursa Malaysia's marketplace being monitored? Would you like to know how the marketplace is maintained orderly and fair? Welcome to Bursa Malaysia. We are the frontline regulator of the equity and derivatives markets. So, what does this mean for you? Through Bursa Malaysia regulation, we ensure the markets you invest in are orderly and fair, so that you have timely, accurate, and complete information to make informed investment decisions. Are able to trade in a fair and efficient environment. Have confidence in your brokers to provide secure and trusted services to you. So, how do we protect the marketplace? We have multidisciplinary teams in Bursa Malaysia regulation that focus on specific areas while collaborating with each other to provide a comprehensive network of safeguards for investor protection. We also work closely with other regulators and law enforcement agencies. Real-time surveillance of the market. We have a market surveillance team that acts as your market police. They monitor the stock market against irregular trading activities in day-to-day trading. This team uses an automated surveillance system to monitor trading in the equity and derivatives markets in real time. Should irregular trading activities be detected, this team of specialized analysts will fact-share and engage the brokers involved for their immediate action. Supervision of intermediaries. As safeguarding the integrity of the marketplace is paramount to us, our intermediary supervision team secures the protection of your trading and deposits through consistent broker monitoring and inspection. Disclosure. Continuing listing obligations and gatekeeping of listed companies or products. To be ASEAN's leading, sustainable, and globally connected marketplace, Bursa Malaysia places high emphasis on the quality of our listed companies. This begins from the approving of new listings on the exchange, through to ensuring that listed companies remain of quality through governance and compliance. As it is imperative for investors to be well informed in the fast-paced financial world, Bursa Malaysia regulations listing and corporate surveillance teams monitor companies' corporate announcements so that they are disseminated to you in a timely and accurate manner. Enforcement action is taken should there be any failure to do so, or should there be any material inaccuracies to the announcements made. As we are also a venue for listed companies' secondary fundraising, our relevant departments work together to ensure investors' funds are always used as mandated. We have a dedicated team of finance experts to examine corporate disclosures, including financial reports, so that they are accurate and timely that you can rely on. Within Bursa Malaysia regulation, we have subject matter experts that look at the various international sustainability reporting frameworks that are constantly evolving to ensure that our disclosure requirements are appropriately benchmarked. This ultimately drives the desired improvements in our PLC sustainability disclosures as well as practices. Taking enforcement action. So what happens when the persons are regulated by us? Be they brokers, advisors, listed companies, directors, or their representatives, breach our rules. Appropriate action will be taken against them. The types of action taken would depend on the severity of the breach. Suspected breaches will be investigated, and enforcement actions will be taken if the breach is proven. Our enforcement proceedings and actions are consistent and fair as cases are discussed in a robust manner through our regulatory committees, comprising independent individuals with relevant experience and backgrounds. Policy and rulemaking. Bursa regulation is the guardian to the 10 rulebooks of the securities and derivatives markets. Rules drawn up by the regulatory policy and advisory team are always outcome-focused. Industry or public consultations with the relevant key stakeholders will be undertaken, alongside rigorous benchmarking processes to ensure the rules are relevant, effective, fit for purpose, and on par with international standards. Each multidisciplinary team in Bursa Malaysia regulation is intertwined and interact proactively to ensure high standards in market integrity.
Hello, everybody. Welcome to today's webinar that is titled Game Plan: What to Do After My Stock Double in Prices. So this webinar is brought to you by Bursa Malaysia and managed by our company LiveChamp. So my name is Shen Chu. I'm the moderator for this session. Now, I'm sure many of you have encountered situations whereby you're thinking, should I let my profit keep rolling or should I take profit? Okay, so this is a common question that investors have. So in the sessions and webinar today, we will address this question. All right. So before we begin, as usual, disclaimer: whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're solely responsible for all your investment risk. Allow me to briefly introduce our speaker today. He is a content producer on kclaw.com, whereby he has written over 300 articles and a regular webinar host and presenter on kclaw.com. He's also a co-founder of Dividend Vault, whereby he transformed newbies into investors who can build dividend portfolios independently via education. So he's none other than Mr. Ian Tai. So Ian, how are you today?
Good, Shane. How are you today, Shane?
Yeah, I'm well. Thank you. So I will want to learn from you. What should we do for our profitable positions? So I'll hand over the session to you.
All right. Thank you so much, Shane. And first and foremost, thank you so much for hosting this session. It's always a privilege to be here, speaking to your audience at Bursa Malaysia. Now, I'm going to share with you my slides, and let's get the whole syllabus right away lah. So today we are going to do some case studies. So it's actually going to be more application based today rather than theory. All right. So guys, you got to participate with me. And just a few house rules before we begin. Number one, if you'd like to interact with us, just kindly just put your comments in the chat box. And of course, if you have any questions, I would love to answer them. Just put it in the Q&A box. All right. So with that, let's begin. So just a brief introduction of myself as an investor. So this is my stock portfolio. And right now it consists about, I believe, 15 to 20 stocks, where my largest holding constitutes about 15.7% of my entire portfolio. Then the second largest will be 13.8%. Third largest is 11.9. So which means to say my top three holdings are actually above 10%. Other than that, the number fourth spot, fifth spot, and sixth all the way to the final spot, they constitute less than 10% of my portfolio. Currently, the portfolio size that I'm now having is six figures. It amounts to six figures, where my annual dividend income is about five figures. And so this is actually my status as of December 2024. Not much changes from here as compared to the present lah, because this is actually typical of investors. We don't actually change our portfolios that much lah. So what we do is that we just buy whatever we believe is to be of a good company, and we just hold on to them for the long term. Now, in terms of geographical breakdown, this is how it is as of December 2024. So out of these six figures, 20% of this will be stocks listed on Bursa Malaysia. A big chunk of it, it's in Singapore, and last but not least, I have a small position in the US. Okay, so this is where my portfolio is standing as of now lah. All right. Now let's get into the whole syllabus for today. Now let's assume that you had invested 50,000 ringgit into three different stocks: stock A, stock B, and stock C. So this is stock A, whereby you have actually made an investment over here. You bought the stock at $14 in June 2016. So June 2016, you invested 50,000 ringgit. You bought this stock known as stock A at the price of $14. So right now, as of May 2020, okay, it has doubled in value. The price is now 28. And therefore, if you want to cash it out, you can liquidate this stock and you will actually receive 100,000 ringgit. So this is stock A. Now, stock B, All right. So for stock B, this is actually the scenario. For stock B, you actually invested $50,000 into stock B at the price of $13. And this is in March 2012. So fast forward to March 2021, the investment that you have made had also doubled in stock price. It has actually risen from $13 to 26. And therefore, if you cash it out at this point in time, you would receive 100,000 ringgit. Okay. So this is the situation for stock B. Now, as for stock C, so same thing again, you invested $50,000 at this point in time in February 2016, when stock C was priced at $135. And as of September 2022, the stock price has appreciated to $270. And therefore, if you cash it out right now, the value of your investment is actually 100,000 ringgit. Okay. So let's type in the chat box. Maybe Shane, you can help me monitor the responses. So what will you do? Okay, type in the chat box. How many of you, after listening to after going through these three stocks, stock A, B, and C, how many of you will buy more shares of stock A, or stock B, or stock C? Type in the chat box. How many of you will continue to hold on to all the shares of stock A, B, and C? And how many of you would have liquidated everything, or you will liquidate maybe just stock A, B, or C? Just type in the chat box. Let me know what will you do. Okay. So maybe Shane, perhaps you want to review some of the responses.
We have a few people who say sell partial, and some say buy more, and some say depends, right? So depends on the fundamental. Okay.
Okay, so a lot of people say sell partial. So I'm not too sure what sell partial means. Shane, what do you think sell partial means? Does it mean that you sell stock A only? You kind of like sell stock A only, but you still keep stock B and C? Or do you sell half of whatever you have invested in stock A, B, and C? Or maybe you
I think
sell
probably
30%?
sell half of ABC. Okay. I think Phil say sell partial A and B.
I see, I see. Okay, so all right, a lot of responses. All right, everyone is actually giving a different response. Fantastic. Okay, now as you can see, here is actually from what I have observed lah. So typically, I'm gonna put stock A, B, and C. All these are actually from Google Finance, and it takes no genius to actually find all this kind of information. Whereby stock A, you bought it here, $14, appreciated to 28. What do you do? Stock B, $13, now 26. What do you do? Stock C, bought it at 170, now it's at 340. So what do you do? Now, typically, for most people who are trading or speculating, that means to say they are traders and speculators. So the decisions are actually made based on stock price lah. So which means to say they just look at the stock price chart. Maybe they are aided by technical analysis tools. Maybe they are aided by all the charting softwares, all the technical indicators and all this kind of stuff. Then from there, they make a decision. Okay. Which personally, I'm not lah. Okay. So as an investor, I do things a little bit differently. So let me just share with you, if I am the one inheriting this portfolio, what I will do as an investor, okay? Now, typically as an investor, what we will do is this. We won't be basing the whole decision whether to buy, hold, or sell any stocks or any securities based on price alone, because price doesn't tell us anything. So as an investor, what we will be looking at is the businesses. So which means to say, what happened here is that for stock A, for stock B, for stock C, the first thing that we'll be looking at would be its long-term earnings, okay? So as you can see, we want to know the long-term earnings of stock A, stock B, and stock C. That's the first thing, the business fundamentals or the income productivity of the stock. The second thing that we will be looking at is what exactly is the valuation behind these prices. So let's say for stock A, we bought it at $14 in June 2016. So what was the PE ratio at this point in time? Was it bought at a good price, which means was it bought when it was undervalued, or was it bought at a premium, which means you have overpaid for it over here? And we will actually fast forward to May 2020, and then we will find out what exactly is the current PE ratio at this point in time. So at this point in time, is the stock really undervalued, fairly valued, or overvalued? And then we will repeat the same old thing with stock B and then stock C. Now, do realize that in this case study, there are three stocks whereby I'm going to just share with you. There are three different situations, three different scenarios, and whereby each of these scenarios, because they are different, therefore, how I will personally react to them will be different. Okay. Now, the general rule of thumb is this. The whole idea here is to look away from price and look at stock valuation. So here we go. Now, let me just start off with stock A. Then eventually I will move on faster at a quicker pace with stock B and eventually stock C. Okay. So guys, if you have a calculator or a smartphone beside you, you may want to use it because open up the calculator function as we are going to do a little bit of maths over here. Now let's take a look at stock A. So from a mindset of me as an investor, what goes through my mind is this. Yes, Google Finance, Yahoo Finance, or any other trading software, it will tell you, oh, I bought stock A and the price is $14. Anyone can do that, no problem. But immediately, what I want to know at this point in time is this. I want to know about its earnings, its latest earnings. So let's say right now it's June 2016. The latest earnings will be the latest 12 months earnings from this point. Or simply put, if let's say for the sake of this discussion here, because it's a presentation, let's just take the earnings of 2015. All right. But typically what I would do is that if this is actually the date, I want the latest 12 months earnings over here. So let's say over here, for the sake of our discussion, we just put earnings 2015. Okay, so I want to know how much it earns here. I want to know the earnings per share over here. I want to know the PE ratio over here. And I want to know the average PE ratio over the past 10 years, which is over here, starting from 2016 all the way up to 2015. I want to know what's the average here. Okay, so this is actually step number one. Now, step number two, from here to here, this is actually a period of time where I have already bought the shares and I'm now the shareholder of stock A. So over here, I want to know whether or not the business fundamentals have improved. I want to know whether the income has been growing, the earnings have grown or not. So this is actually a period where I want to assess the business fundamentals, and the assessment is done by looking at its income productivity, whether or not its earnings have grown over the past, let's say 2016, 17, 18. So it should be 3 or 4 years. Okay. So I want to know what's the earnings over here. And then also I want to know what is the PE ratio, what's the progression like over here. Next, at this point in time, I want to know what's the latest earnings over here, what's the earnings per share over here, the PE ratio, and the average 10-year PE ratio from this point to this point, which is 10 years, okay? So do note the years carefully. So I want the 10-year average at the point when I purchase it, and as well as the point where I am assessing what to do over here. So do take note of that. Now let's take a look at the first part, okay, which is the earnings. So this is stock A, and this is the earnings, okay? So what happened is that we have the blue color bar over here, and we have the red color bar over here. So the blue color bar represents the period before I purchased the stock. So let's say before I purchased the stock, as of June 2016, as an investor, I would have gotten this information from the stock's annual reports. I would have known that, okay, so this is stock A's earnings. It has actually, it has been profitable. And starting from 2009, it has increased in terms of its earnings, up from $67.1 million all the way up to $215.9 million over here. So at this stage, this is actually where I invest. Now, the red color bar represents the period after I become a shareholder. So after I become a shareholder, this is what happened to stock A in terms of earnings. Initially, it's just on par with whatever it has made in 2015. Then it has a marginal increase, and then the increase is more substantial. And then finally, we are over here at 2019, where it has made $291 million. Okay, so from here to here, there's an earnings growth. So as a shareholder, type in the chat box, will you be happy to invest in a company where you're assessing, where initially this company is making $215.9 million, and now after a few years of holding onto the company now earns this amount of money, which is $291 million. How many of you are okay with this? If you are okay, just put in a thumbs up. Let me know in the chat box, okay? All right, so thank you so much, Albert. Seems that you're okay with it. So in this sense, I would say that did earnings grew consistently? Then based on what I see on this chart over here, the answer is yes. All right, for stock A, earnings have grown consistently. In fact, from here to here, it is actually a plus 34.8% increase over 4 years. So this is actually very good. All right, thank you so much for the response. Now let's move on. Now this is the earnings per share for stock A. So it will kind of like resemble the earnings graph or the earnings chart over here. So let's just quickly go through the earnings per share. Before you buy, as of June 2016, the latest earnings per share would be 71 cents. So this is the time when you invest. Over time, because of earnings growth, your EPS have actually increased from 71 cents to 95 cents. Okay, so did EPS grew consistently? The answer is yes. Okay, so in terms of earnings, done. Most of you guys are happy. Even I myself also quite happy. Now let's take a look at valuation. So now this is stock A in terms of PE ratio. Over the past 10 years, these are the PE ratio as highlighted in purple. Okay, so here, this is June 2016. So we backdated 10 years. So backdated 10 years, it will be 2006 all the way to 2015. Okay, so these are the PE ratios. And the average of these 10 years worth of PE ratios would be 17.11. Okay, now you bought it here at $14, where the earnings per share for 2015 is 71 cents. So how do you calculate the PE ratio that you have purchased? Where you take $14, you divide it by 71 cents, and there you go. You have 19.72. So guys, type in the chat box. Is this a discount when you compare this current PE ratio with this average PE ratio? Is this a premium or a discount? Put it in the chat box. Let me know. Okay. So if you think that this is a premium, type in premium. If you think that this is a discount, hey, you have kind of like slightly overpay for it. You can either type premium or you can type in overpay. Just put it on the chat box. Yes, so CS Wang, premium, Ronald, premium, Albert, premium, correct. Fantastic. All right, so what I will do as an investor is that, let's say I purchase it here. June 2016, I purchased it at $14. So what I will do, my own habit lah, is to track the business performance of stock A. So I will track its earnings and I will also track its PE ratio on a year-on-year basis. So this is actually what happened to stock A after I have purchased its shares. So in 2016, its PE ratio is 20.76, then 21.15, 21.71, then eventually it hits 30.89, okay? So now, because 4 years has already lapsed, so what I'll do is that, can you see that initially the 10 years is here, as represented by this yellow or golden color kind of arrow? Now you have to move this 10-year arrow to the green color one. So now you're starting from here to here. So from here to here, the average is 19.85. And when you assess the stock price at this point in time, okay, so it's not that you have bought at 28. Let me just put, now the price, now the current price, okay, the current price of stock A is at 28. The earnings per share have grown to 95 cents. So now you can take your calculator, you can take 28, you can divide it by 95 cents, and therefore your PE ratio at this point in time is 29.47. So 24.97 is higher than 19.85. So this is actually now how it looks like. So this is Google Finance. This is what everyone can get online. Okay. Doesn't take a genius to find this. But what goes behind the price are all these things: the business fundamentals, the PE ratios. So over here, we found out that, hey, over here, the PE ratio is 19.72. It's a premium because you have bought it at PE ratio higher than its average, which is 17.11. Earnings grow here? Yes. Right now, you're at this point, $28. Earnings did grow, the earnings per share did grow, but the PE ratio has also grown to 29.47. The average PE, 19.85. Okay, so now we have this kind of information. So guys, with this information, what would you do as an investor? Would you now want to buy? Or would you want to hold? Or would you want to sell? If you want to buy, how much more you want to buy? Would you actually top? Okay, just make it easy. How many of you will want to buy? How many of you will want to hold? Or how many of you will want to sell off stock A at this price? Type in the chat box, let me know. Okay, so for Albert, you will want to hold, take the dividend first. Okay, so Patrick says sell. Ronald Chong says hold. Okay, fantastic. So Peter says sell all. Okay, thank you. So how many? Alan Ching sell. En Seng Hock sell. Okay, so it seems that there are more people wanting to sell over holding it and nobody wants to buy. Okay, fantastic. So here is actually what I will do. Kennedy says may sell if need money. Augustine, take profit. Phil says sell half. Doris Tan, PE 29 is high. Sell a portion of it, then average down when the price go down. Okay. So everybody has a different response, but here is actually the more standardized approach when you have this kind of information. So for those of you who say sell, I'm actually with you. Why? Simply because when the PE is like 20, the PE here is 29.47. It's not exactly low. It is actually an amount which is a lot higher than the average, which is 19.85. Since we have this kind of figures, therefore, at this stage, it's time to actually go short. It's time to actually sell off stock A and liquidate and realize your investment rewards. Sell. Now, here's the thing, okay? So what if you don't sell? let me just explain what happened after that. So after that, from 28 here, the stock price has actually come down and it has actually moved sideways. And as of the time when I prepared this slide, the price of this stock is at $18.42. Okay. So now you are at over here. So which means if you don't sell when the stock price is actually kind of like premium, overvalued, high PE ratio over here. If you don't sell it here, then you may lose the chance to actually sell off the stock and realize a good reward. Okay. So here it says share price fell by 34.2% for the last 5 years to 18.42. So you bought at 14, it went up to 28. You know that the PE ratio is 29.47. It's time to sell. But if you don't sell, then at this stage, your capital gain is a little bit low lah. Still got capital gain, but not as much as over here. Okay, so that is actually the case lah. All right, got it? So that is stock A. And now let's move on to stock B. Let's see what we can learn from stock B, okay? Now I'm going to start off again with the same whole scenario. Over here, you're at $13. You bought it at March 2012. Once again, we want to know the earnings figures and the PE ratio. Once again, we want to know the business fundamentals from here to here. What's the progression like? And at this point in time, we want to know where it stands in terms of valuation. So now I'm going to go a little bit faster and then you guys participate, yeah? Okay, so this is stock B in terms of earnings. So over the past 10 years, the blue one represents a period when you are considering to buy. So this is actually March 2012, okay? So this is March 2012. And what you have gathered is this kind of earnings. 1.1 billion, 1.1, 2 billion, 0.8, 2.2. So overall, it's profitable. There's some ups and downs here, but overall, it kind of like go up. All right. And you decided to buy over here. After that, the earnings of the company has actually increased. Up here, up here, up here. 3.8, 3.7, 4, 4.5, 4.2, 5.6, 6.4. Okay. And then in 2020, there's COVID-19, but the company makes 4.7 billion. So this figure is actually in yellow because it's COVID-19. It's a period where there's abnormally lah, okay? There is an unusual business condition over here because it's COVID-19. So typically as investors, what we want to do is to assess the company's ability to generate income or generate earnings under normal business conditions, not exactly influenced by one-off events or some windfall, some events that will bring in a one-time windfall or a one-time loss due to tragedy, okay? So let's say we are going to use this as our basis of valuation, where the earnings of the company is $6.4 billion. Now, think about it. You bought it here when the company is making $3.0 billion. After you have become its shareholders, it actually increased its earnings all the way up to 6.4. And even during COVID-19, the earnings is still $4.7 billion. It still make money and it make a lot more than here. Okay. So this is the earnings per share figures. It started off here at $1.30, goes up to $2.46. And then this is COVID-19, $1.81. So did earnings per share grow consistently? The answer is yes. And now this is the PE ratio of stock B. The purple represents the period where you are considering to buy. Now, you're buying it at $13. Based on the earnings per share of $1.30, your PE ratio at this point is 10. If you backtrack it 10 years, the average PE ratio is 12.39. So guys, is this a discount or is this a premium? Just type in the chat box, let me know. Okay. Average PE, 12.39. At this point, the PE is 10. So let me know whether this is a premium or a discount. Should be very obvious to answer. Now, over time, as a shareholder, you kind of like track the PE ratio. 10.68, 11.96, 13. So you kind of like track 9.8, 14.7, and finally you are here. But this is an abnormally, okay? But anyhow, here are the figures. At this stage, stock B, the share price is at 26. Based on 2019 earnings per share, which is $2.46, you take 26 divided by 2.46, your PE ratio is 10.57. From here to here, the average PE is 11.5. Okay. So now you have this information in your hands. Stock price has doubled. Stock price double. So the PE ratio here is 10. Here is 10.57. The PE ratio, the average PE over the past 10 years over here is 12.39. From here to here, it is 11.5. So guys, now you know this information. The question is, what will you do with stock B? Would you buy more? Would you sell? Or would you hold on to stock B at the price of 26? Type in the chat box. Okay. So Ronald Chong says buy. Okay. Patrick Lim, buy. Chingo. Chingo says what? Buy. Eng Seng Hock, hold. Young man, hold. Tan Hong, buy. Patrick Lim Chi Meng, hold and buy. Albert, hold and buy. Hold, hold, hold. So only one sell, okay? So only one person. Phil says sell. The rest will be either holding or buying. Okay, fantastic. Now let's take a look. So this is the situation. And now let's take a look at what happened if you happen to hold here. And or what happened if you buy stock B at $26 in March 2021. Okay. And of course, what happened to you if you sell here? Let's take a look. So typically, for me, when I look at this, based on the PE ratio, which is 10.57, which is below its average, I will either hold or buy. Okay. Now let's take a look what happened. Okay, so this is actually what happened to stock B, yeah? So let's say you hold or you buy here. What happened is that currently the stock price has actually increased from here to here, from 26. Now it's at 46 lah, $45.85 as of March 2025. So which means to say, if you happen to sell here, then you will miss the opportunity to have these capital gains lah. But if you choose to hold, then at least some of your money will be, you will be able to enjoy some form of capital appreciation over here. And of course, if you buy more over here, then congratulations, you will be able to reap even more rewards from stock B's capital appreciation. So congratulations to those who actually hold and buy. Okay, stock B. Now we have actually gone through stock A and stock B. So how many of you can see that there is a difference in terms of situation between stock A and stock B? All right. Both actually double in price, but the situation is very different. How many of you can see? If you can see, just type in can see. All right. Just type in, let me know. Two different scenarios. We have to assess it very differently. Okay, so Doris Tan, thank you. Can see. Albert Man, see. Chingo, yes, can see. Can. Okay, fantastic. All right. So with that, let's move on to our final case study for today, which is stock C. Now pay attention, okay? So it's the same thing. It doesn't matter. So it doesn't matter what the price the stock is lah, okay? So think about it. Let's start from stock B. Let's start from stock A, or I show you this graph lah. So it doesn't matter what price, you know. It can be 14 to 28. It can be 13 to 26. It can be 170 to 340. It doesn't matter about the quantum of the stock price. The quantum of the stock price doesn't really matter. Do take note of that, okay? Now we're going to go into stock C. Let's take a look. The same formula. Once you see the price at Google Finance, ask yourself, don't just look at, oh, price here, 135. Immediately switch your focus to the earnings, to the EPS, to the PE ratio, and the average PE as of 10 years before this date, 10 years over here. Over here, we want to know the earnings growth, and over here, we want to know the current valuation. So let's take a look. So this is stock C. If you take a look at the light blue, this is how much the company, stock C, is making in terms of earnings. It's starting off at $9.4 billion. And then gradually it goes up to $17.3 billion over here. So this is at the time where you invest into stock C. Then after being a shareholder, the stock actually report this kind of earnings. Okay. From 17.3 billion, it has increased to 17.6. Slight drop over here, but eventually it goes up to 23.3, 23.5, 22.3, and right now 26.2. Okay. I believe that how many of you are happy to find this kind of earnings after being a shareholder? If you're happy, type in happy. Let me know. Okay. So from here to here, what exactly is the percentage of growth? So the percentage of growth is 51.3% in 6 years lah. So as a shareholder, what makes us happy is that the company that we invest in, right, actually makes more and more money, more and more income, more and more earnings. That makes us a very happy shareholder. In terms of earnings per share, this is how it looks like. Starting off at $7.03. This is earnings per share. So it is actually so because you see that, hey, the earnings per share here has increased, you think that this is actually fundamentally a good company. Good. So therefore it actually forms part of the reason why you buy into the company. And after being a shareholders, its earnings per share increase 7.14. It drop a bit to 6.06, then it goes up to 9.46. Then right now it's at 11.57. So this is very good. Now let's take a look at the PE ratio. So this is stock C. You bought it at 153. You divide it with its earnings per share at that point in time, which is $7.03. Your PE is 19.07. But if you backdate it over the past 10 years, the average is 18.64. So 19.07, average 18.64. Okay, seems to be very close, although this is a little bit higher than this, but it seems to be a tiny bit of premium, or you can say almost similar, very close already. Okay, so guys, there's no right or wrong, just want to know your opinion. When you look at this, right, how many of you say this is overvalued, and how many of you here are a bit more slack, or in the Malaysian slang, cincai? All right, okay lah, lebih kurang lah, okay, lebih kurang, tak apalah, okay. So if you are one who is actually quite straight, saying that, hey, no, this is overvalued, type in overvalued. If you are one of those who are a little bit cincai, a little bit, ayah, boleh je lah, after all so close, type in the second one, Chinchai or something like that. Let me know which type of investor would be more resemble to you. Okay. So let's see. Augustine. Okay lah. All right. Means to say it's close. Ronald Chong, lebih kurang. All right. Fantastic. Patrick Lim, a bit overvalued. Okay. Doris, overvalued. Ng Seng Hock, acceptable. Kennedy Buddha, acceptable PE, a bit chincai. Okay. So different people have different level of acceptance lah. Okay. So no right or wrong. Just want to get to know your feel lah. Okay. Now, over here, you track the PE ratio. It goes from 90.07, which is here. Then it goes to 22.83, 21.37, 23.54, 24, 25.84. Now, at this point, you bought it at 270. Not you bought lah. So now the current price is 270. The current price is 270. Earnings per share 11.57. So the PE ratio at this point, okay, let me just draw the line. Okay. Now at this point, it's 23.34. Now the current, okay, the 10 years average, the average PE ratio, which starts from 2012 to 2022, the PE is 22.65. Again, 23.34. Average 22.65. Seems to be close, but this is still higher than this. What do you make of it? Okay. Now I'm going to just share with you this slide. So at this stage, now we have to make another decision. Here, the PE ratio is 23.34, but we know that the average is 22.65 over here. Okay. All this information we know. Business performance is not bad. From here to here, the earnings have grown. Here, however, we see that the PE ratio here is a little bit higher than here. So now at this stage, what to do? Should we sell? Should we hold? Or should we just buy more of stock C? What will you do for stock C? Type in the chat box. Okay, so Albert Mann says looks good, got potential. Patrick Lim says hold. Ronald Chong says hold. Chingo says hold. Albert says hold and buy. Doris says, I can see this is a good company. I will hold. Ng Seng Hock hold. Peter Ching, sell half. Augustine Koch, sell half. Phil says sell. Oh, okay. Kennedy Buddha, can buy more. All right. Thank you so much for your response. So with that, let's review the results. What do you think will happen? Okay. Let's take a look. So because the PE ratio at this point in time is super close to its average, so you can actually say you can hold or you can actually buy more. Both also correct. All right. So if I were to inherit this portfolio for stock C, I will either hold or buy. Okay. Now this is what happened to the stock after September 2022. From here, it kind of like increased from here to here. It has actually appreciated from 270 to $495.62. Okay. So the share price has rose by 83.6% over the last 3 years. So which means to say, if you hold, then congratulations, you will have more capital gains. And if you happen to buy more over here, then your capital gains have become even more. All right. Because you buy more, then of course, whatever you buy here and buy here, you definitely have a gain over here. So congratulations for those of you who actually hold and buy. Right? So what are the key takeaways for this webinar session? So here I purposely picked 3 stocks, 3 different scenarios. The first one, where all the 3, right, earnings have grown, which means the business fundamentals are okay. But the first one, the PE ratio is a lot higher than its average. So in that case, we sell. Okay. The second situation is very much clear-cut, where the PE ratio, after you have invested, the PE ratio is actually below its long-term average. So in this case, we can either hold or buy. But the third one is more like a tricky question. It's more like a trick question where the PE ratio is not exactly higher a lot. It's not exactly a lot higher than the average, but it's actually quite close. So at this stage, what do we do? Some say hold, some say buy. So this one is actually quite dependent on whether or not this stock C is your thing or not lah. Whether you prefer to own more stock C or not. That's a personal preference. But anyway, here are the key takeaways that I would like to hand over to you guys for today's webinar session. Number one, whenever you look at Google Finance, Yahoo Finance, or whenever you open up your stock brokerage account, you look at the stock price, don't just immediately invest or make any decision based on price alone. Okay. Now, there's a caveat lah. Unless you tell me today that, hey, Ian, I'm actually a trader. I'm a speculator. I'm not an investor. I'm not into investing. Then fine. Then you're playing a different game. However, if you're investing for the future, you're investing for the long term, your purpose of investing is for your retirement. Your purpose of investing is that you like to accumulate shares of fundamentally good businesses and you want to hold on to them for the long term. Just like Warren Buffett, then you are welcome to don't just look at the stock price, but always look at the business fundamentals and the valuation of the stock. So that's number one. Number two, when it comes to all the three stocks, they kind of like double in price, but it doesn't take 1 year or 2 years. It takes some time before the stock price actually double. And typically, when you actually deep dive into the reasons why they actually grow, why their share price can actually appreciate over the long term, the main driver of it is their earnings growth. So whenever you want to invest and you are investing for capital appreciation, most of them comes from earnings growth. Of course, there are some cases whereby capital growth, especially the ones that are very short-term in nature, it is actually caused by speculative growth. But do you want to actually do that if you are a long-term investor? Do you want to aim for that? Is there a formula to actually make a profit out of manias? I don't know lah. So because I do not know how to do it, so I didn't really share with you how to do it here in this webinar. But if you say, I want to invest for long-term capital growth, and I want the long-term capital growth to be justified or backed or supported by the company's business fundamentals, then by all means, just focus on the company's income productivity or earnings growth. Now, these are three different situations. So what happened is that based on PE, and there can be a few more valuation tools. But if you find that the stock is super overvalued, then do not hesitate, just sell. And if you happen to find that the stock price has doubled, but the PE ratio seems to be fairly valued or undervalued, then it is actually pretty good to either hold on to them or buy them. Okay. So with that, thank you so much for attending this wonderful webinar session, packed with 3 case studies. And I'm sure that you have a lot of questions related to stock investing. And I'd like to pass the control back to Shane. Shane, all yours, man.
Thanks so much, Ian, for sharing with us your perspective on when should we hold, when should we sell, right? So if any question to ask Ian, you may write your question at the Q&A box.
Now, as we wait for the question, so something just came out to my mind. So it's like, when exactly will I hold? All right, because there's a case where there is stock B and stock C. When exactly do I hold? And when exactly do I buy even more? So what are the prerequisites? What are the criteria, right? So I do not know about Shane. Maybe Shane, you can actually share later on. but I'll just review mine first lah, okay? So whether to buy or hold, right? Once again, it all comes to this decision over here. So for me, it's not so much about, oh, what stock should I buy or when should I buy and all this kind of stuff. So this is actually my portfolio. So I have about 15 to 20 stocks over here. Largest is 15.7% and the rest is actually below 10. So what happened is that the decision to either hold or buy, right, is actually very much dependent on my weightage per stock. So let's say, for example, stock A is the one lah that I think I should be either holding or buying more. So what happened is that if my position over here, so let's say I put a cap lah, which means at any time, my position in stock A should be capped at 20% of my portfolio. So since this is about 15.7%, then I will just add a little bit more to make it 20%. If that is actually my rule lah. Of course, if let's say there's another stock where, let's say stock E, right now is at 7.5%, and I find that the PE ratio is nice, everything is nice, it's time to buy, then I will up my investment from 7.5% all the way up to 20%. So so how much percentage I have in the stock in my portfolio will actually determine whether I should be holding and what exactly is the quantum of my investment, okay, if I want to buy. And of course, if let's say I have a stock, I already have 30-40% of my investment holdings into that stock, and then still the PE ratio is very nice. Do I add more? I try not to lah. Okay, I try not to. But that's just my own take lah. Shane, any add-ons? If you find a good opportunity, when exactly would you actually tambah? Or when would you not tambah?
Case by case basis lah. Yeah, but generally I also don't. I want to keep my portfolio allocation right size lah. Okay, I probably wouldn't have any stocks that's more than 10% weightage, at most of the 10%. Yeah.
I see, I see. Nice, nice, nice. So Shane, do we have any questions from the floor?
Oh yes, certainly. Okay, the first question is by Fee Thing. Why do you use average P ratio? Would that be relevant? And why do you benchmark against the past 10 years? That's a
Oh,
question from him.
that's just my way of assessing. So when I have long-term data like this, then I have a few of its roughly lah. Roughly, if let's say the average, what stock is this? Let's say stock A lah. Okay. So stock A is, as you can see, the stock price can go up and down. Usually it goes up, but if I look at the PE ratio, right? And the PE ratio is more or less constant like this, then I roughly have a gauge lah. I roughly have a gauge what exactly is the fair valuation of the company. So I will actually take 17.11, the PE as its fair valuation lah. So which means to say, as an investor, I try not to buy a stock at this point in time when the PE ratio is above 17.11. As a matter of fact, I will just try to aim to buy a stock when the PE ratio is below 17.11, because the objective of investing is also to make sure that you are cost effective lah, or cost efficient. Cost efficient simply means you don't try to overpay for a stock. And the method that I like to use is to actually see what's the average PE and try to buy lower than that. So that's my take.
All right. The next question is by Patrick Lim. Okay, for all those three stocks, ABC, if those stocks, if their payout percentage of dividend varies, should we need to consider this as one of the consideration instead of earnings per share or the PE factors?
Mm, okay, so this is a case by case study lah. Okay, so it is also, it can be part of the consideration. So let's say I'm a dividend investor, right? And my sole objective is to build a portfolio that generates dividend income. And so we have A, B, and C. And so A is one where you buy purely for dividends, which means to say the company's earnings. Let's say every dollar it earns, it pays out, let's say 80-90% of its earnings out to shareholders in the form of dividends. So in that case, then yes, you can replicate the whole thing. You can even do this. So this is earnings. This is EPS. So you can also expand. You can also expand to include DPS over here, which is dividends per share. And you can also include average DY, which stands for dividend yield. And then you can do the same over here and the same over here to help you make a better decision. You can do that. No problem. Okay. So this is actually something that I believe is doable. That's number one. Number two is that let's say you are investing in a company and that company pays dividend, but the dividend payout ratio for that company is not 80-90%, but 20-30%, which means every dollar in earnings per share, it pays out, let's say, 30 cents in dividends. The other 70% of the earnings is retained with the company so that the company can use it to grow the business. And you have a position in that stock for that purpose, okay? Because you don't just want to build a portfolio that is just generating good dividends only, but you also have some stocks, it pays a little bit lesser in dividends, but it is a growing business. So what do you do with that? You still can also do this, okay? But however, because you are buying that for another purpose, which is the growth part, so you may also want to keep track of what exactly is the growth initiative of that company. And you can actually consider that and factor that in before making a decision, like to buy, hold, or sell. Yeah, you can do that.
Thanks, Ian.
Mm-hmm.
So if the company C, the dividend payout ratio is 0, should we consider to sell rather than hold and buy?
So it all depends on the objective, right? So if let's say company C is one that does not pay any dividends, then you may want to find out why is it not paying dividends, right? So in the context of Malaysian companies, usually the good ones that are bringing in more and more earnings, usually more or less they will pay out dividends, because in Malaysia, the dividend, the tax policies on dividends is still very friendly. So more or less, companies in Malaysia, listed on Bursa Malaysia, should be paying dividends if let's say they are fundamentally solid. So if you are just sticking into Malaysia, that is actually the case But if let's say you are going outside the country, let's say Singapore or the US, Singapore is still friendly, but for US, the tax policies may not be that friendly, okay? So that is another consideration So you may want to find out if a company that is not paying out dividends, you may want to find out why. The why is actually very important. That's number one. And another why is you have to ask yourself why you want to invest in that stock. So is there any specific reason why you want to invest or include that stock into your portfolio? And this ultimately ties with what exactly is the objective for you building your portfolio.
All right, thanks, Ian. The next question is by Eugene. So with the possible recessions coming, what is your cash allocation in your portfolio right now in terms of percentage?
Cash allocation. Depending on scenario, I have very little cash at this point in time. So it's more, so you can say my cash allocation is quite negligible lah,
So you are quite fully invested now, lah.
more or less fully invested lah.
Okay. But since you are a dividend investor, so I guess
I
dividend
have
income are
cash.
more important to you. So your portfolio should be, low beta type, whereby you can withstand the worst of volatility, right?
You can say that lah, but I have cash flow, but uh low in cash lah, because whatever cash flow comes in, I just somehow find a good company and just buy shares lah.
Mm,
Mm.
all right.
But don't but with that said, that's very personal lah, okay? That's very personal. It has a lot to do with how you want to plan it out in terms of the family. Like for example, I'm married with a wife, but she has a different strategy, for example. Then how do you actually gel the two together? All right, so that's actually forming part of the plan. So you don't necessarily have to follow like almost zero kind of cash allocation. Don't take it blindly. But last time I will have a lot more cash allocation lah than before. So it's very situational, very personal.
All right. So any trigger for you to review your portfolio and decide on what percentage allocation for each stock is gonna be like?
Trigger, like what kind of trigger leh?
Yeah, there's a question by Kennedy.
Usually I don't really couldn't think of any trigger at this point. Maybe the trigger somehow rather, let's say something happened to the stock and then the stock just plunged or the stock just went up like so much percent, then I would just review the fundamentals of the business. So if let's say the business is okay, there's no significant change to the business, but the stock price actually just went crazy. Okay, it just went up like so much, then thank you lah. It's like you buy a property at 200,000, you are happily renting it out for $1,000 a month. Then out of nowhere, because of one guy who kind of like my apartment, want to pay me 500,000 for that apartment, it's a valid deal, then okay lor, thank you so much lah. All right, I will just cash it out and sell the property to him lah. So that's one way to look at it. But of course, another way is that, let's say the apartment from 200,000, don't know for what reason, it actually just plunged to 100,000. Or my next door neighbor is actually selling his house at 100,000, which is half the price of what I pay for. Don't know for what reason lah. And then you check everything, all no problem what? No problem with the apartment. Still can rent it out easily for 1,000 a month. Then I will ask my banker lah, see whether I got the loan quota for it lah. Then if I can get the loan, then I will buy the property lah. So it's just that lah.
All right, thanks, Ian.
Mm-hmm.
So the next question is by Patrick. So when we consider to buy or hold a good company that has a PE better than the average, do we also review this company's debt level?
Yes, you can actually review the company's debt level lah. So it depending on what kind of businesses that you own lah. Okay, so like banks and REITs are actually separate. How you assess the debt level is separate. But normal businesses, you can have a few types lah. Okay, so if let's say you want to build a sustainable portfolio, you may want to include also companies that have very low or negligible debt levels lah. All right, so you may want to include that into your portfolio, which means companies that have strong cash flow, sizable cash, not too much, just enough to run the business, all right? And it has very low debt or negligible debt. You may want to include that in as a stabilizer in your portfolio. That one I'm okay. So you also, of course, you can actually include a few companies where their debt levels are a bit high. Don't discount. I didn't actually discount that, but I may not put a lot of my investment into that kind of company lah. But even if I put in also, I want to make sure lah. Let's say the company has $3 billion in long-term debt. However, this company can generate 1 billion a year in operating cash flow. So technically speaking, if the company wants to do that, if the company wishes to, it can actually pay off its debt within 3 years. So if I can kind of like measure it that way, then fine. Then okay. The worst thing is to buy a company that has $3 billion in debt, but then you couldn't actually figure out how predictable this company's cash flow generation is. Maybe sometimes cash flow positive, sometimes cash flow negative. You can't actually tell. So with that kind of company, usually they are not in my portfolio lah. Usually they are out. I won't include them in the first place.
Thanks, Ian.
Mm-hmm.
Doris would like to ask, for value investor,
Mm-hmm.
which is more important for long-term growth? Do you think it is return on equity, or do you think it's P/E ratio? That's her question.
Return on equity.
Okay.
All right. At the
Would
end
you
is
explain more?
at the end of the day is the earnings growth lah. All right. The earnings growth of the company is actually the most important. Now, return on equity is a measurement of capital efficiency, which means say how efficient the company is in using shareholders' capital, shareholders' equity lah, or shareholders' money to generate the earnings. So I wouldn't make it like a hard and fast rule, but typically lah, all the companies, right, should have positive return on equity. That's a must lah. Now, the second criteria will be whether or not the ROE is single digit or double digit. So if it's double digit, then it is actually more efficient lah, as compared to companies that have single digit ROEs lah. But this one is also dependent. You have to do peer-to-peer comparison, which means say if you are looking at manufacturing company, then you have to compare with another manufacturing company. So it's apple-to-apple comparison lah. So that is actually the case. But of course, beyond Malaysia, like in the US, there are companies that have negative shareholders' equity simply because of a lot of share buybacks. So what do you do with that kind of company? You can't even calculate ROE, right? So that one you need to actually use another formula. Perhaps the formula to use to replace ROE is return on invested capital or return on capital employed. So that is actually another way to measure capital efficiency lah. So at the end of the day, capital efficiency measured by ROE is going to be a more important metrics as compared to PE ratio. Actually, there's a study. I forgot who did the study. Maybe it's Charlie Munger, I think. Someone asked him this question. He says, oh, if the ROE of a company is like 18% and the PE is at certain level, which is, let's say we have stock A and B. A has higher ROE, but PE is also a little bit higher lah. B, the ROE is a lot lower, but then the PE ratio is a bit lower. So at the end of the day, you do the maths, right? It is the one that has higher ROE that still wins lah. So which also means that the priority should be first put on the business fundamentals over the valuation. So it's fundamentals first, then only valuation.
Yeah, I remember Charlie Munger made a remark that says that he would rather buy a great company at a fair price
Mm.
than to buy a fair company at a great price. So he,
Correct.
yeah, in other words, he favor companies strong with strong growth, and he would buy it at a fair price. Okay, instead of buying it undervalued. Okay.
True.
So the next question is by Mahalingam.
Mm-hmm.
So, what is your view on all this trade war or tariff war that keeps changing? And his view is that Bursa keeps following the US market. So, can we hold for long term in these circumstances?
You first and foremost, you must know what game you are playing, lah. Okay. So if you are playing the investor game, it's very different from the trading game. And of course, speculators, I do not know lah. Or people who are just trying their luck. They are just coming into the stock market, do not know what they are. They may not come in with a plan. They may not come in with any skill, any sort of strategies or whatsoever lah. That's a totally a different story. Okay. So first thing is to know your game plan. Now, I only can share what my game plan is, and my game plan is to invest. Invest means I just want to focus on good companies, hold on to them, and just make sure that the companies that I invest in, I track their earnings growth. If they have grown over time, they should actually deliver some returns to me lah. Okay. So in terms of trade war, pandemic, terrorist attack, political instability, locally and global, in terms of interest rate hikes, in terms of crude oil prices that changes, that fluctuates. Actually, as an investor, we have to learn how to embrace volatility. Okay, so you have to somehow know how to make volatility your friend. And the best way I feel, in order to make volatility a friend of mine as an investor, is to do valuation. So which means to say, if let's say there's a tariff and this tariff is not gonna look good on Malaysia, for example, and it causes the stock price to actually fall. So it's actually a volatility. It's actually a risk. Oh, because tariff come, something bad happen, bad news, then it goes down. But because I have to be mentally trained and mentally be conscious to look away from price and look at valuation. So when price drop, then I start to calculate the valuation. If let's say the valuation of the business that I like because the fundamentals of the company is nice and I intend to keep it. The valuation is nice, fundamentals nice, then I'm more trained to actually just grab it lah. Just come in and invest in the company and hold on to the shares. So that is one way I feel lah, how you can make volatility your friend. To add on, how do you actually make all these factors that I talk about, the tariffs, the change of leadership, political leadership, the change of regional conflicts, global events, local events, macam-macam lah. All right. Anything and everything that could have impacted the stock market. How do you make this into your worst enemy? Is to see, oh yo, something happened in the stock market. Oh, price drop. Oh yo, price drop means bad things happen in the market. Better run, oh. then in that case, you are more geared towards running away when the market is bad, and then you are more geared towards coming into the market when things all look rosy and all things are bright, all things are rosy, all things are sunshine and beautiful. Wow, economy is booming. Then you're more likely to come in at that point in time. So that is actually another example of how people may actually end up buying way higher than investors and selling way lower than investors. So somehow rather you have to make all these things not your enemy, but your friend. That's my take.
Thanks, Ian.
Mhm.
So the next question is by Peter Chin. So for a stock like C, sometimes the
Mhm.
company may suddenly announce a quarterly loss. So
Mhm.
and the stock price will plunge, right? So how do you avoid getting caught like that?
The question is, how often does the company report a loss? That is a question. Ah. So if it's too often, it should not happen in my portfolio. If it's just one time and it's justifiable, maybe it's because, oh, maybe there is an incident that happened to the company and it causes the company to incur a one-time loss. Maybe it's an impairment loss. It's a one-time event, then fine. But if it's too recurring, then it defeats the purpose of building a portfolio uh, that is aimed or that is geared towards long-term earning, long-term growth in earnings. So, so I'm wondering how frequent is the quarterly loss? Why does it happen? As long as you don't have a justifiable reason to justify why this quarterly loss keep on happening and how frequent does it happen, then no good lah. But if you have a valid reason of why it happened, I may also not too interested in investing in that company. But if it's just a company that has been quarterly earnings growing steadily and just one quarter affected because of external events, I'm fine with it. I'm okay. As long as it is commercially justifiable, fine. That's my take.
All right. Thanks, Ian.
Mhm.
Now that I think the market is a bit fearful, so Eugene would like to ask,
Mhm.
what is the thought about the 10-year or 2 years treasury bond inverted yield curve as a leading indicator for to forecast recession?
I don't
You
I
don't
don't know.
trust that indicator?
Not to say I don't trust. Is number one, I do not know of that. Sorry lah. I do not know of that indicator lah. That's number one. Number two, I'm not exactly in the I don't exactly go and track or predict when the recession will happen. It's not part of my game plan. Will recession come? Perhaps, maybe, yes, in my lifetime, there will be a few recessions lah, but I do not know when. So my method of building a portfolio is to always think about it this way lah. It's like fireman lah, all right? It's like fireman in the balai bomba. I do not know when the fire will happen, but every day do I train to somehow handle a fire in case it happens? The answer is yes. Okay. So which means I didn't go and uh, predict when the fire will happen, when the recession will happen. Rather, I'm more concerned on one thing, which is my preparedness of a recession. So which means I tend to I tend to focus more on my preparedness than to predict when a recession will happen. Does it make sense to you, Shane?
Yep, I understand what you mean. Okay.
Yeah, so I didn't know of the indicator simply because I wasn't into predicting when something might happen in the future. I just at the back of my mind, I say all these things could have happened lah, because all of us have lived through COVID-19, right? Once you live through COVID-19, I believe the mindset is anything and everything can happen in the stock market lah. So the idea here is to be always be ready, always be checking your finances, always be prepared.
All right.
Mhm.
The next question is by Fitting. So, what do you think about market sentiment or external issues like um, short sellers who that can manipulate the price?
Uh, I don't know because there may be some punters here, some short sellers there, but the whole idea is that uh, don't focus too much on that lah. I didn't focus too much on that lah. But anyway, when you focus too much on that, right, then what is the game plan? What exactly is your whole intention of building a portfolio lah? So for me, I would say that I do not know how these games are being played, and it's actually not really part of my study lah. So I do not know, but I'm more interested in finding out what exactly is the business of the stock. If you ask me, let's say stock, a certain stock, and then you ask me about the business model of it, the financial results of it, I may have an idea, or in fact, a study behind it. But if you ask me about short sellers, what's going to happen in the market, would a recession come? That one I don't know lah, honestly.
All right. So let's do one last question from Ronald. So Ian, since you're in Singapore, right? So I mean you have some portfolio in Singapore. So the question from him is, are the Singapore and Hong Kong dividends taxable?
From my studies, because I'm not a tax agent, okay. So off the cuff lah, stocks from Hong Kong, there will be I believe that, okay, I haven't actually buy a stock that is, okay, let me just rephrase that. I bought a stock that is listed in Hong Kong, but its businesses are running in China. So that one, the dividends, I paid about 10% in withholding tax. But as to a stock that is running that is listed in Hong Kong, running in Hong Kong, I don't know. I don't have the figure at this point in time. Maybe it's 10%, but I don't know. But if it's a China stock, then yes, it's 10%. For Singapore, it's a single tier system. Once they deliver the dividends to you, you get it lah. So there's no tax at this point in time. That's my belief.
All right. Thanks, Ian. So looks like we have run out of time to ask any more questions. So with that, I want to conclude the Q&A session. So thank you, everybody, for tuning into this session. Thank you so much, Ian, for doing this session for us. Hope that all of you here have learned from Ian's perspective on when should you do sell, when do you hold on, or when do you buy more of the stocks, even if it double in price. All right. Thanks so much, everybody. So thank you so much, Ian.
All right. Thank you so much, Shane. And thank you so much for attending this webinar session. It's a pleasure. It's a joy.